Boom! What is up, Waves Capital? It's Royce Jacob. Welcome back to the channel. In this video, we are going to be talking about the massive wave of earnings reports that's scheduled to be released this week and why the outcome of these reports will likely dictate the fate of the markets for the foreseeable future. Okay, so before we get into the specifics of the company's reporting, as well as just the general macro calendar, what you guys should be keeping an eye out for as we move into this week when it comes to the markets, I do want to cover this CNBC Pro article titled, "This Earnings Season Will Be Tough as Inflation Erodes Margins," Barclays says. So, as you guys know, as we've been talking about a lot on the channel and in the newsletters as well, inflation is scalding hot. Inflation has been the talk of the street, and how the Fed chooses to fight inflation, which we will be covering a little bit in this video as well, and the craziness around speculation around the raising of rates. Inflation is the talk of the town once again, and inflation has not yet caught up to earnings. So Q1 earnings, when they were reported a few months back, inflation was bad, inflation was hot, but inflation wasn't scalding hot like it's been over the past couple of months. So in this article, we'll touch on why inflation will, quote, erode margins, and this will just set kind of the ground argument for my bearish sentiment as we move into some of the specifics once again. Okay, so after we talk about inflation and its impact on margins, we'll cover this article talking about why earnings could be an even bigger catalyst for stocks after the market's wild ride on rate fears. Okay, go over some key points. We will then scroll down and take a look once again at all of the companies reporting earnings. Some massive names in here, you guys. This will once again set the tone for the markets for at least the next few weeks until the next macro, and probably until the Fed meeting, I guess. So this is a very, very important week when it comes to macro, and yeah, we'll go over the specifics and some of the companies announcing, as well as, once again, a few other things to keep an eye out for this week as well. Okay, after all of the fundamental talk, after all the macro talk, we'll close out on the charts and take a look at good old BTC, take a look at Bitcoin. Bitcoin and the crypto markets ultimately are a pretty good gauge of what the markets will do as we enter a new trading week. So they do act, in my opinion, as kind of the most accurate futures market for equities. So we'll take a look at BTC. And again, you guys, right now, BTC has been gaining some strength. We have not yet been able to break some very, very significant resistance. And in my opinion, it's really, although I'm an optimistic guy, it's really not looking too good, especially considering I remain bearish on the equity markets, given this massive week of earnings reports. Okay, so that is the video, you guys. But before we dive into all of that good stuff, I feel it's necessary to reflect on last week, on that little relief rally that we closed out last trading week with, go over some bank earnings, and also talk to you guys about just the state of the S&P 500 and why I'm personally skeptical on the correction that we've seen so far, and why I actually think it's ridiculous that there are analysts out there who think we've bottomed, and why I'm absolutely calling the bluff on some of the relief that we've seen over the past few sessions. Okay, so as many of you know, this is my macro newsletter. Write this every single trading day, and yeah, let's kick it off by reading this once again. Just reflect on last week, and this also includes my general thoughts on the markets and how I'm personally kind of attacking the markets when it comes to my portfolio construction. Okay, so the markets headed into the weekend on a high note following earnings from Wells Fargo and Citigroup. So big banks, JP Morgan Chase, Wells Fargo, Citigroup, all reported last week, and it was very mixed. So anyway, the fact that these stocks are popping is a good testament to how little consistency there is in the markets right now. So Wells Fargo was up like 6%, and Citigroup was up 14%. Wells Fargo stock is up significantly, but they disappointed on both revenue and profits when it came to the already lowered analyst estimates. I'll attach some metrics below. So, as you can see here, Wells Fargo said Friday that the second quarter profit declined 48% from a year earlier as the bank set aside funds for bad loans and was stung by declines in its equity holdings. Okay, so Wells Fargo is not down 48% in the past year. And the fact that it popped 6% is once again a good testament to how little consistency there is in the markets right now. Okay? People, I mean, the fact that earnings are coming out, period, maybe some investors find some solace in that. But I mean, again, you guys, this is, in my opinion, just to sum up my current thoughts on what happened in the past couple of days of the week. I think this is a massive bull trap, and I think this week is going to get pretty ugly. Okay, so I'll just preface that now. In case you're a bull, tune out now. But if you kind of agree, let's expand on some of these. Let's just rationalize this logic. Okay, so I'll let you guys pause here. We don't need to go over the metrics here, but yeah, Wells Fargo up 6% on very, very disappointing. Just pretty damn disappointing reports. Okay, even from lowered analyst estimates on their reports. Okay, so there's not only a lack of a lack of consistency, but there's a clear lack of general understanding as well when it comes to what's really going on with the macro. Myself included. So I gotta admit this, you guys. Myself included. The markets have seen significant relief today following a week of nonstop, objectively bad news. Growth stocks have gotten irrationally oversold. Therefore, it makes sense to me that they see some lasting relief. But the fact that there are investors and analysts who believe the bottom is in for the major equity indices, the S&P, the NASDAQ, and the Dow, is once again ridiculous to me. Okay? It'd be foolish of me to claim that I have a definite stance on what the outcome of the markets will be due to the lack of economic clarity. But as I said in the Trade Alert newsletter, I'm absolutely calling this bluff. And I included this little graphic in the newsletter. I honestly don't even get it, but I thought it was appropriate. So, I mean, just wanted to throw that out there. It's rare to see 50% of analysts bullish and the other 50% bearish, but we're seeing that polarization display itself very clearly in the price action of the markets. When the short term is so uncertain and speculative, I feel it's important to zoom out and take a look into the past, which is what we'll be doing down here. Below, I've attached my chart of the S&P 500 on weekly candles dating back over 20 years. I've labeled the dot-com bubble in 2000 and the housing bubble in 2008, both of which saw 50+% corrections from peak to trough, or from top to bottom. Okay, as I've said previously, I don't believe we'll see a correction or crash quite of that magnitude given the base differences of those two time periods to now. But the fact that the S&P 500 is only 20% off of the most inflated highs we've ever seen can't be justified in any logical manner. Okay, so when we take a look at this, you guys, again, dot-com bubble right here, housing bubble right here, both the dot-com bubble, again, when you throw .com at the end of pretty much any stock, kind of similar to the ICO bubble, the initial coin offering bubble that we've seen over the past few years, or once again, the DeFi bubble that we're seeing really pop now with Celsius, 3AC, Luna, etc. That was like the first iteration of the .com bubble. So that was different in the sense that, once again, these were void companies without any actual revenue. These were complete story stocks, okay? That's what made that environment a little bit different. The housing bubble, again, like terrible loans were given out. Pretty much everyone defaulted on their home loans, and pretty much there was a massive flaw in the underlying financial system that was exposed here, and that is the difference back then. So you could argue that right now in 2022, because of the amount of liquidity that was injected into the markets and that kind of just evaporated and is now being there, and now we're having so much liquidity withdrawn from the markets and just from the economy via the Fed trying to induce a recession, like manually induce a recession, actively induce a recession. You could say that, in a sense, part of the financial system is breaking as well. But this was, I mean, there were so many moving pieces that tumbled over that caused the housing bubble. So I don't think a 58% correction in the S&P is likely right now. As of the close on Friday, the S&P has only corrected 20% from its all-time high, which once again is the most inflated high ever. And it just doesn't make sense to be that this is the end. Do we see a 50-60% correction? I don't think so. Do we see a 30 to 40% correction given the fact that we're so overinflated and that the Fed once again is actively fighting the markets right now and the economy and wanting to induce a recession to fight inflation? I think a 30 to 40% correction in the S&P 500 in the king of the equity markets is a lot more likely than not. Okay, so when it comes to short term, I do think that this earnings season will catalyze at least, or this week of earnings, honestly, could very well catalyze another 10% down to the 2020 high. That green, this green line right here is 2020's high in February of 2020, prior to that little pandemic black swan event we saw prior to the rip back in action. And I do think, you guys, we talk about the reversion to the mean a lot around here, which is the revisiting of the initial highs of the rally, or the previous high, or the all-time high of the previous rally, prior to the new rally. We're seeing that in Bitcoin right now. I think at the very least, the SPY will see a revisiting of the February 2020 high. And I do think it's also likely that we see a further correction from there to test these multiple trend lines, which are just long-term, very, very macro trend lines, given the state of the macroeconomic backdrop, which once again is a bit bearish on alfalfa. So when it comes to price targets, I just covered that. Don't have to reiterate on that. But earnings haven't been horrible so far. They've just been bad. It's still early in the season, though, and I think there are some exceptionally bad reports looming on the horizon, which the one I'm really looking out for is Tesla on July 20th or this Wednesday. And always know, you guys, my money is where my mouth is. So if you guys want to know how I'll be trading through this week of earnings, and every day from there, if you choose to stick around, check out my complete portfolio and daily newsletter. Welcome to the winning team. If you do, Waves Capital, the winning fam. This includes, for $15 a month or $40 for every 3 months, a complete breakdown of my entire personal portfolio, all options, stocks, and cryptocurrencies, which I update every single trading day during market hours and alert you over at Waves Capital with those updates. You'll also receive my 3 daily newsletters, which include my trade alert, my macro analysis, which is what we just read through, and my price targets, which as you can see right here, these are the names that we cover on the charts in price targets. And yeah, you guys, this is on a daily basis. Okay, so if you want to join Waves Capital, if you want to take a step up, that is going to be the first link in the description box down below. Once again, you choose your pricing plan. That's completely up to you. And you can always unsubscribe, but I'm confident that you'll stick around. And once again, welcome to the winning team if you do. That said, let's dive into this earnings season. Will be tough, and the impact that inflation could have. Okay, so inflation will be a key headwind during the second quarter earnings as higher prices eat into companies' profit margins, according to Barclays. In recent quarters, companies were able to maintain margins by drawing down on inventories built up at lower prices and by selling it to cash-rich consumers. Analyst AMD wrote in a Thursday note referring to wallets boosted by stimmy checks and built up savings in the early days of the pandemic. So this is what we've been talking a lot about, right, you guys? Like, when there's helicopter money, when there's money falling from the sky, pretty much, when the Fed is just handing stimmy checks out to everyone, when people aren't working, when people aren't spending as much out at restaurants, when you're getting unemployment checks and not really having to work for your money, that creates a very unhealthy spending pattern, which is still carrying over into today. Okay, so that's not good. Again, everyone's run out of money, and just look at the markets, you guys. Look at what's happened to the markets. The markets are a great reflection of consumers' pocketbooks and how much consumers are comfortable spending. Okay, so again, you guys, that's just a general way to think. But now, however, inflation and commodity prices are high, which is quickly burning through the stores of cash consumers have saved. This is keeping margins under pressure even as the supply chain improves. High levels of inflation can hurt margins as seen during the 1970s to 80s, even as earnings growth is not affected due to its nominal nature. So given the significant increase in recent realized inflation due to supply chain disruptions and higher commodity prices, some softening in margins is expected. Okay, so again, you guys, this isn't rocket science. This is kind of just common sense. Again, the price of everything is higher. A very easy correlation to make here as to why, again, like Walmart and Target disappointed heavily on earnings is because they have to pay shipping costs for a lot of their products. Shipping costs when, again, container ships are still backed up, when it's way more expensive to ship a crate across the ocean or a container across the ocean, those big massive containers, whatever brand you see on the side of those massive metal containers, that's more expensive. The cost of gas and fuel is obviously more expensive, making travel in itself, making shipping in itself more expensive. It's a very bad very net negative. Negative catalyst for revenue, for the bottom line revenue, more so bottom line profits, not so much revenue, but the profits of companies, those of which are reporting this week. Okay, so just a heads up there, you guys. Let's take a look at the earnings that are being reported this week. But again, just sum up kind of the week ahead and the calendar ahead before jumping into BTC on the charts. Okay, so key points. Earnings could be a main driver of stocks in the week ahead after a roller coaster ride on changing sentiment about how much the Fed will raise interest rates. Hot inflation data initially sparked speculation the Fed could raise interest rates by a full percentage point or 100 basis points, but by the end of the week, strong data and comments from the Fed officials squashed those expectations. In the week ahead, investors are looking to housing data and expect earnings from a broad swath of companies to steer stocks. Broad swath of companies. Funny terminology, but let's take a look at that broad swath of companies. Okay, so in the coming week, earnings news could set the tone as a diverse group of companies report. Big banks continue with reports on Monday with releases from Bank of America and Goldman Sachs. Johnson & Johnson, Netflix, and Lockheed Martin post results on Tuesday. Tesla and United Airlines issue their quarterly figures on Wednesday. AT&T, Union Pacific, and Travelers are among those reporting on Thursday. And lastly, American Express and Verizon both release earnings on Friday. So, again, you guys, a lot of state like pinnacles of the American economy, of American industry, are reporting earnings this week. And again, the banks, again, like JP Morgan, disappointed. JP Morgan was down, but the banks were all over the place when it came to earnings. But even when you listen to like what we covered in my last video talking about JP Morgan's earnings, even when we talk about the words from Jamie Dimon, everyone's pretty aware of what's going on. And it's pretty obvious that even in the rare case that earnings don't heavily disappoint this week, there are a lot of economic hurdles on the horizon. And again, that's just very evident in the data. Okay, so besides earnings, there are a few key data releases, mostly around housing. The National Association of Home Builders, or NAHB, Wells Fargo Housing Market Index will post on Monday. Housing starts are out on Tuesday, and existing home sales are due on Wednesday. On Thursday, there is the Philadelphia Fed Manufacturing Survey, and finally, both manufacturing and PMI services are released on Friday. Okay, so these, given the gravity of the companies who are announcing earnings this week, I do think that these are just going to be kind of supplemental catalysts to what the markets decide they'll do. But again, you guys, personally, just given the state of everything, even though we saw relief on Thursday and Friday, even though there is but definitely boosting optimism, you can see here stock futures inching higher. I'm going to call the bluff. That's my opinion. Again, it's all speculative, but just given everything that we've been talking about for months now, all of the objectively bearish news that it's very difficult to just justify any silver lining for. I do think that this week of earnings is going to be ugly. And hey, once again, you guys know I'm prepared with some puts on deck, and I'm also excited to potentially redeploy the profits from those puts into some nice long-term call options and stock positions as well. So once again, first link down below if you want to join Waves Cap. Okay, anyway, let's close it out by talking some good old Bitcoin. Bitcoin has finally tested the line of resistance. If you guys watched the last Riot Bitcoin video we covered, we were waiting for this, and it has finally happened. So Bitcoin, this cyan trend line right here, very, very significant, dating all the way back to April of this year. So first touch point here, boom, another touch point, 1, 2, 3, 4, 5, 6, 7. Very, very significant line of resistance. It makes perfect sense that it did come into play, and we did just officially test this yesterday. Actually, today, we officially tested it at about 21,000, just under 21.7K. And once again, you guys, considering Bitcoin and the crypto markets, our great insight, or in my opinion, are the real equity futures market. So let's actually take a quick look at this, stock futures and higher. So stock futures, I can just go to the homepage. Stock futures are up pretty significantly at the time of writing, but what I found is that stock futures really mean nothing, and what does hold weight is the performance of the crypto markets. Okay, so crypto looking down, and the fact that Bitcoin is facing once again a very, very significant, very evident line of long-term resistance right here that has and is currently posing as a massive threat to the bulls when it comes to BTC. Is worrying me and is leading me to believe that although futures are in the green right now, it's pretty obvious that the markets are going to see downside. Once again, also given the fact that we just read over all of this and some gnarly earnings reports are looming. Okay, so BTC again has been very, very unimpressive over the past couple of months, holding up well, which I will again really proving its point that it can hold up well in times of crisis and maybe can be a chaos hedge and inflation hedge in the future. But right now, I do think one more wave to the downsides in the cards. A lot of you guys know, especially if you're part of the newsletter, that 14K is kind of my base black swan event. I do think we can get back down to 10 to 12K, but $14,000 is kind of the base from a macro perspective. That's where I really think we'll base out and kind of bounce around from 14 to 20 prior to likely whenever the next cycle is, maybe start in 2023 and definitely go into the halving in 2024. But again, you guys, this is a timely process. If you've been in the markets for a while, you would know that this things don't just happen overnight, especially given the fact that so many retail traders have been washed out and just had their spirits crushed, which is actually a very, very big factor when it comes to reinvesting in the markets and redeploying capital and seeing another bull run come back. So again, wounds take time to heal. That's just the nature of nature and the markets as well. But right now, you guys, Bitcoin not looking good. Again, perfectly tested long-term resistance. Daily Stokes, as you can see right here, the daily stochastic RSI is about to curl back to the downside, following almost like a triple top pattern, which could also be like a weird head and shoulders, which is a pretty rare sight when it comes to stochastic RSI. Standard RSI is well above the EMA or exponential moving average, which is kind of good, but I do think that's going to come down to at least tested. If it falls below that, very bearish. We saw it back here. Again, kind of bouncing around. Once it fell below, we saw that massive sell-off. So in the case that we see another wave to the downside, that was a 44% drop. Do I think we're going to see another 44% down from here? The second wave being 44%. You know what? It's possible because that would take us down to about 12K. I don't think that's very likely. But again, I do think that 14,000 is likely. I do think we could see another 30% to the downside. And I do think that it's not Bitcoin in itself that'll cause this. It is the equity markets that will bleed over into Bitcoin. Okay, so that's the video, you guys. Please let me know in the comments down below what you guys think will go down over the course of this week. If there are any specific companies that are reporting earnings that you're playing right now or you're keeping an eye on. And hey, if you're part of Waves Capital, please just zoom back out. If you are part of Waves Cap, let me know what you're excited about in the portfolio. Okay, so I'll catch you guys downstairs in the comments. I'll see you guys if you are part of the YouTube fam in a few days. If you're part of the newsletter fam, I'll see you bright and early in the morning. And until then, always remember, take action, make waves. Peace.